There's something Wall Street doesn't want you to know, something the Federal Reserve won't talk about, something the billionaires who manage trillions of dollars understand perfectly but will never explain to regular people. It's a pattern, a 5-stage sequence that appears before every major financial crash. Not most crashes, every single one. 1929, the crash that triggered the Great Depression. 1987 followed it. Black Monday, when the market dropped 22% in a single day. 2000 followed it. The dot-com bubble, 2008 followed it. The financial crisis that nearly collapsed the global banking system. And here's what should terrify you, we're following that exact same pattern right now. Let me tell you a story. It's September 5th, 1929. There's a business conference in Massachusetts. The stock market has been on an absolute tear. Everyone's getting rich, the mood is electric. Then a man named Roger Babson stands up to speak. He walks to the podium and says 9 words that will make him the most hated man on Wall Street. There's something Wall Street doesn't want you to know, something the Federal Reserve won't talk about, something the billionaires who manage trillions of dollars understand perfectly but will never explain to regular people. It's a pattern, a 5-stage sequence that appears before every major financial crash. Not most crashes, every single one. 1929, the crash that triggered the Great Depression. 1987 followed it. Black Monday, when the market dropped 22% in a single day. 2000 followed it. The dot-com bubble, 2008 followed it. The financial crisis that nearly collapsed the global banking system. And here's what should terrify you, we're following that exact same pattern right now. Let me tell you a story. It's September 5th, 1929. There's a business conference in Massachusetts. The stock market has been on an absolute tear. Everyone's getting rich, the mood is electric. Then a man named Roger Babson stands up to speak. He walks to the podium and says 9 words that will make him the most hated man on Wall Street. Sooner or later, a crash is coming, and it may be terrific. The audience laughs, mocking laughter. The newspapers ridicule him. Irving Fisher, the most celebrated economist in America, dismisses Babson publicly. He declares that stock prices have reached what looks like a permanently high plateau. 47 days later, the stock market crashes. Total, complete, catastrophic collapse. Irving Fisher loses everything, his entire fortune gone. He dies in poverty, broken, and humiliated. Roger Babson makes a fortune. He was positioned for the crash. He became one of the wealthiest men in America. So what was the difference? Fisher was brilliant. Babson wasn't lucky. The difference was that Babson understood the pattern. He had developed a systematic method for analyzing financial conditions. 5 factors, 5 stages. In 2007, it was mortgage debt. Banks created exotic instruments that let people buy homes with no money down. They called them ninja loans. No income, no job, no assets. The banks packaged those mortgages into securities and sold them as safe investments. When home prices stopped rising, the whole structure imploded. In 2000, it was corporate debt. Companies with no profits were borrowing billions. They used stock as collateral. When stock prices fell, they went bankrupt by the hundreds. Now look at today. Official margin debt is around $750 billion, but that number is incomplete. Add in securities-based lending, another $800 billion. Add in the leverage embedded in options markets, trillions in notional exposure. Add in corporate debt over $10 trillion, most of it used to buy back stock rather than build businesses. Add in government debt, $34 trillion. The interest payments are now larger than the defense budget. When you add it all up, total debt in the American economy as a percentage of GDP is now higher than it was in 1929, higher than 2008, higher than any point in recorded history. Stage 1 isn't just flashing red, it's on fire. Crashes don't happen just because prices are high. They happen because risk gets concentrated. When a small number of assets carry a disproportionate share of the market's value, the system becomes fragile. One asset stumbles, everything else gets dragged down. In 1929, the market was dominated by glamour stocks. Radio Corporation of America went from under $2 to over $500 in a few years. RCA made up a huge percentage of the market's value. When it cracked, the whole market cracked with it. In 2000, it was the dot-coms. The NASDAQ was essentially a bet on 10 companies: Cisco, Intel, Microsoft. When those rolled over, trillions in wealth vanished. In 2008, concentration was hidden in the banking sector. 5 banks held the majority of derivatives exposure. When Lehman went down, it nearly took the entire system with it. Today, the concentration is staring us in the face. The top 7 stocks in the S&P 500 now account for over 30% of the entire index, sometimes closer to 35%. Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. When you buy an S&P 500 index fund, which is what sits in most 401ks, you're not really buying 500 companies. You're making a massive bet on those 7 stocks. If those 7 stocks drop 50%, your diversified index fund drops 15 to 20%, even if every other stock stays flat. And here's the thing, those 7 stocks are trading at valuations that require perfection. Not good earnings, perfection. Any disappointment in the selling feeds on itself. Passive investing has made this worse. Every dollar that flows into an index fund automatically buys more of the biggest stocks. Prices rise, their weighting increases. The next dollar buys even more. It's a momentum machine on the way up. On the way down, it reverses. Every dollar out sells the biggest positions first. Forced selling creates more selling. The virtuous cycle becomes a vicious spiral. Because so much money is in passive index funds now, trillions of dollars, the selling pressure when it starts will be unlike anything we've ever seen. This is stage 2, the concentration trap, and we're deeper in it than ever before. This is the stage that reveals how the game actually works. Before every major crash, institutional investors, the banks, the hedge funds, the billionaires, quietly reduce their exposure. They sell, they raise cash, they buy protection. They don't announce it, they don't warn anyone. In fact, their public statements say the opposite. They tell you to stay invested. They tell you the fundamentals are strong. They tell you not to panic, and while they're saying that, they're heading for the exits. In 1929, the Morgans and Rockefellers started liquidating in the summer, months before October. Bernard Baruch was almost entirely in cash by September. Joseph Kennedy sold everything. Regular Americans kept buying. They were the exit liquidity for the smart money. In 2007, hedge funds started shorting subprime mortgages a full year before the crash. Goldman Sachs bet against the same securities they were selling to clients. Executives at Countrywide were dumping their personal stock while telling investors everything was fine. Regular Americans kept buying houses and bank stocks. They were the exit liquidity. Now look at today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, board members, the people who know what's happening inside these companies, are selling at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every insider buying, multiple insiders are selling, sometimes 10 to 1, sometimes 20 to 1. Mark Zuckerberg has sold billions in Meta stock. Jeff Bezos has sold billions in Amazon. Nvidia insiders have been selling at the fastest pace in the company's history. Meanwhile, retail investors have been pouring money into the market. Robinhood accounts, 401k contributions, record amounts. The smart money is selling, the regular people are buying. This is not a coincidence. This is the pattern. This is how it works every single time. Stage 3 is flashing red. This is the sneakiest stage. Everything still looks normal. Prices are stable, maybe rising. Trading volumes are healthy. Nobody's panicking, everything seems okay. But underneath, the liquidity that supports the market is draining away. Liquidity is like oxygen for financial markets. When there's plenty of it, everything functions smoothly. When it disappears, markets stop functioning. Prices don't adjust gradually, they gap. Small sell orders move prices by huge amounts. The crash feeds on itself. In 1928 and 1929, the Federal Reserve raised interest rates repeatedly. They were trying to cool speculation. What they actually did was drain liquidity. For a while, nothing happened. The market even kept rising. Then October came. When selling started, there was nobody on the other side. The bids vanished. Stocks went into free fall because there was literally no liquidity. In 2007 and 2008, same thing. The Fed had been raising rates. Credit conditions were tightening, but the stock market stayed high. Housing prices stayed high. Everything seemed fine. Then Bear Stearns collapsed, then Lehman. Suddenly everyone realized the liquidity was gone. The market dropped 50% in 18 months. Now look at today. The Federal Reserve has raised interest rates at the fastest pace in 40 years, from 0 to over 5% in less than 2 years. The fastest tightening cycle since Paul Volcker in the early 1980 seconds. They've also been running quantitative tightening, pulling hundreds of billions of dollars out of the financial system, draining reserves, reducing liquidity. And yet the stock market is near all-time highs. People think this means the tightening doesn't matter. They think we've achieved a soft landing. They're wrong. The stress is already showing. March 2023, 3 major banks failed in a single week. Silicon Valley Bank, Signature Bank, First Republic. Why? Liquidity crisis. When depositors wanted their money back, the banks had to sell bonds at a loss. The losses triggered runs. The runs caused collapse. The Fed had to step in with emergency lending programs. They essentially printed money to backstop the banking system while claiming they weren't doing a bailout. Those emergency programs are temporary patches. They don't fix the underlying problem, they just delay it. The Treasury market has been showing signs of stress too. The most liquid market in the world is having plumbing problems. Think about what that means. This is stage 4, the liquidity illusion. Everything looks calm on the surface. Underneath, the oxygen is being sucked out of the room. This is the one nobody can predict, and that's what makes it dangerous. Stage 5 is the event that turns a vulnerable market into a collapsing market, the spark that lights the fuse. Here's what people get wrong. They think the trigger causes the crash. It doesn't. The crash is caused by stages 1 through 4. The debt, the concentration, the smart money exit, the liquidity drain. Those create the conditions. The trigger just determines when. In 1929, the trigger was the Hattrey case. A British financier got arrested for fraud. Nobody in America cared, but British banks had to raise cash. They sold their American investments. That selling created more selling. Within weeks, the market was in freefall. A minor British fraud case triggered the Great Depression, not because the fraud mattered, but because the system was so fragile that any shock would have done it. In 2000, the trigger was the Fed raising rates. Suddenly, the free money funding .com companies dried up. They went bankrupt. The contagion spread. In 2008, the trigger was Lehman Brothers, but it could have been Bear Stearns or AIG. The system was primed to explode. So what's the trigger going to be this time? I don't know. Nobody knows. That's the nature of triggers. But I can tell you the candidates. It could be geopolitical, a real escalation over Taiwan, something unexpected in the Middle East. Oil prices spike, inflation roars back, a miscalculation with Russia. It could be financial, a major hedge fund blows up, a sovereign debt crisis, a derivatives accident. The derivatives market is over $600 trillion in notional value. One major counterparty failure could cascade through the system. It could be the banking system. More regional banks failing. Commercial real estate is a disaster right now. Office buildings are worth 50% less than their mortgages. Banks sitting on huge unrealized losses. It could be political, a constitutional crisis, a debt ceiling standoff that goes wrong. The US defaults on its debt. Treasury bonds are no longer risk-free. The foundation of global finance cracks. Or it could be something nobody is talking about. That's usually how it works. The trigger is never the thing everyone is worried about. What I do know is this: when stages 1 through 4 are all flashing red, the trigger usually arrives within 12 to 24 months. We've had all 4 stages confirmed since late 2024. That puts the window somewhere in 2025 or 2026. Let me tell you what this doesn't mean. I'm not telling you the market is going to crash tomorrow. I'm not saying sell everything Monday morning. I'm not predicting a specific date. Timing is impossible. Markets can stay irrational longer than you can stay solvent. Anyone who tells you they know exactly when the crash is coming is lying. I'm also not telling you to sell everything and hide in a bunker. That's not a strategy. That's panic. What I am telling you is this: the conditions that preceded every major crash in the last 100 years are present right now. All 5 stages are either active or imminent. The question isn't whether you believe me. The question is, what are you going to do with this information? Roger Babson didn't just predict the 1929 crash. He prepared for it. While everyone else was leveraged, he held cash. When the crash came, he bought real assets at pennies on the dollar. He was positioned to thrive. Irving Fisher, the genius who mocked Babson, lost everything. He died in debt, broken. His name became synonymous with being spectacularly wrong. The difference wasn't intelligence. Fisher was probably smarter. The difference was that Babson paid attention to the signals. He respected the pattern. He positioned himself for what was coming instead of what he wished would happen. You have the same choice right now. You can look at this data and decide it doesn't apply to you. Markets always recover, right? This time is different. The Fed won't let it happen. Whatever story you need to tell yourself. Or you can ask yourself uncomfortable questions. How much of your wealth is in the stock market right now? Your 401k, your IRA, your pension, your home equity. How much is concentrated in a handful of mega cap tech stocks? Go look at your S&P 500 fund. You might be shocked. How much of your financial security depends on prices staying where they are or going higher? If the market dropped 50% over the next 18 months, which is what happened in 2008, would you be okay? Would your retirement survive, or would you lose a decade? These are hard questions, but you need to ask them now, while there's still time. I'm not a financial advisor. I can't tell you what to do, but I can tell you what the pattern shows. The people who get destroyed in crashes aren't stupid. They're just unprepared. They trust the experts who say everything is fine. They believe the system is more stable than it is. They assume someone would warn them if something was really wrong. But nobody warned them in 1929. Nobody warned them in 2000. Nobody warned them in 2008. Nobody's going to warn you this time either. The warning is the pattern itself. And now you know it. You know about the credit explosion. You know about the concentration trap. You know about the smart money exit. You know about the liquidity illusion. You know that a trigger is coming. That knowledge gives you an advantage. You can reduce your exposure to the most concentrated positions. You can hold more cash. You can own assets that do well in deflationary crashes. You can have a plan, or you can ignore all of this. You can believe that this time really is different. But before you do, remember Irving Fisher. Remember all the people who thought they were safe in 1929, in 2000, in 2008. Remember that they all had reasons to believe things would be fine. Remember that they were all wrong. The pattern doesn't lie. History doesn't care about your hopes or your plans. It just repeats the same 5 stages, the same outcome. And right now, we're in stage 4, heading towards stage 5. The choice is yours. Look, I know this is scary. I know you might be thinking, great, now I'm gonna worry about this every day. That's not what I want. Knowledge isn't supposed to paralyze you. It's supposed to empower you. The crash of 1929 didn't have to destroy so many lives. The signals were there. The pattern was clear. People chose not to see it. The crash of 2008 didn't have to wipe out retirement accounts. The warning signs were flashing for years. People chose to ignore them. This time doesn't have to be the same. You have information most people don't have. You understand the pattern. You see the stages. What you do with that information is up to you. Knowledge isn't power. Applied knowledge is power. The 5 stages are here. The pattern is clear. The question is, are you going to be Roger Babson or Irving Fisher? Are you going to prepare? Or are you going to hope? Because hope is not a strategy, and the market doesn't care about your hopes. The pattern is the warning. Now you've been warned. If you stop here, you're still missing the key piece that connects everything. You might know what to do now, but not how to move forward strategically. That's exactly why I made another video. It goes deep into the current economic setup, how it impacts your wealth building journey, and how to position yourself before it's too late. So don't waste time. Click on the video that's showing up right now on your screen and complete the blueprint to becoming a real success story.